Well, you got the market, which is still there with a 20-odd point a pop, not a decisive move by any yardstick. 1:1 advance decline ratio. Even that number, that gap between advances and declines, it is waxing and waning. I mean, right now there is a 70-80 point stock difference between advances and there you go. It's almost 1:1, no difference. Shibani Sircar Kurian is Senior Executive Vice President and Head of Equity Research at Kotak Mahindra Asset Management Company. She's joining us right now to take some questions. Shibani, good to have you with us here. You know, the fund managers from the Kotak house that we've spoken with over the last 2-3 months, I mean, actually since the end of the third quarter, there has been sort of a sense of caution on, earnings for FY24, potential for more downgrades. With 50% of fourth quarter earnings season now behind us, Shibani, what is your team telling you? What kind of downgrades or upgrades are we going to see for FY24?
Hi, Prashant. Good afternoon. Pleasure to be here as well. So you're right. When you look at the earnings season has so far been largely in line with estimates, especially when you look at the Nifty companies that have reported. So as of yesterday, about 29 Nifty companies had reported, and at a headline level, overall numbers have been largely in line with estimates. Margin benefits are now being seen with commodity costs and input cost pressures coming off, and on a quarter-on-quarter basis, in some pockets, you are starting to see that margin benefit come through. However, when you just go a little deeper and look at numbers, while the Nifty headline numbers and earnings estimates for FY24 remain largely intact, with consensus expecting mid to high teens earnings growth in FY24, when you look at the broader market and say you look at the top 200 companies, there you are starting to see wide dispersion in terms of earnings performance. So it's not a very uniform performance. Also, within sectors, what is clearly standing out is that the domestic facing sectors are delivering better in terms of earnings. And therefore, even at a Nifty headline level, financials continue to be the key driver, along with a few companies within the automobile space, which has been driving the overall earnings growth trajectory for Nifty. The global cyclical sectors, which is oil and gas and metals, continue to drag down earnings. And this quarter, of course, IT has also been somewhat of a disappointment. And that has resulted in some earnings downgrades within the sector, which have been offset by the upgrades that you've seen in autos as well as financials. So net-net, we believe that so far, if you look at Nifty trajectory for FY24, earnings expectations are still fairly intact. However, this is going to be a year when you look at the broader market, there is going to be dispersion in terms of earnings delivery within stocks at a broader level. So therefore, stock picking is going to be very, very crucial this year.
Shibani, ITI nor technology per se was a big negative surprise. No one was anticipating such weak numbers from the big boys. But can you highlight some trends where you were positively surprised or negatively surprised outside of technology? Because banks, while they've been good, largely in line with what the street was anticipating. What were the key trends that you would take away from these quarters' numbers?
So you're right. So far, apart from technology, where there was some amount of negative surprise, which is also maybe somewhat stock specific in nature, the numbers by and large have been in line with estimates. So there have been no major negative or positive surprises as such. While banks have done well in terms of earnings delivery, again, as you rightly pointed out, a lot of that was baked in terms of estimates and expectations. I think one key factor to look out for, or maybe a couple of trends that we want to look out for going into maybe sometime in FY24 is one on the auto space. If the overall growth trajectory continues to improve both for four-wheelers as well as for two-wheelers, given that there are some nascent signs of improvement where rural demand is concerned, that could be an area where you could start seeing improvement on the earnings delivery front. The second, as a theme that we are looking out for, is on the rural space. Of course, there are conflicting data trends and nothing concrete as such. But at the margin, it does appear that some amount of the impact or downtrend that you have seen on the rural demand is bottoming out. And therefore, that could be one area to watch out for. And that would have impact for sectors such as FMCG, two-wheelers, for instance. Apart from that, in terms of our portfolios, where we are looking at sectors, we continue to remain positive on banks. We believe that while the earnings delivery is possibly baked into numbers, valuations continue to be favorable, and therefore the financial services space is something that we are positive on. Apart from industrials, manufacturing, capital goods, autos, and cement. So these are some of the sectors which are all domestic-facing sectors which are growing and contributing to earnings growth, where we continue to be positive on.
Okay, got that. Shibani, since you're talking about banks, hi, good afternoon, Surabhi here. So since you're mentioning banks, of late, this chatter is growing a little louder. The impact of the new provisioning norms, I mean, they've not yet come into force, but at some point in time, that draft circular will become official and we'll move towards this expected credit loss system of provisioning. Do you see that having any sort of a material impact? And what specifically is your call on PSUs? Because that's where the hit will be perhaps a little bigger.
You're right, Surabhi. However, when you look at the draft circular in terms of implementation and what will be the final outcome, we'll have to still wait and watch. The way we are approaching this is that when you look at the banks and the way to understand what could be the possible loss or the possible impact would be, one, to look at the portfolio composition. Therefore, higher retail share where credit costs have been lower will mean that the impact is lower. Also, the provisioning levels that banks are carrying today, higher the provisioning coverage, higher the contingency or extra provisioning on the balance sheet, lower will be the possible impact because of the implementation of this Ind AS or ECL methodology. And thirdly, of course, the capital position for banks. Now, with this construct, what we believe at this point in time, the private banks are better placed. Number one, they are carrying significantly higher levels of specific provisions on their balance sheet. So anywhere between 75 to 80% provisioning coverage ratios, apart from extra contingency provisions. And secondly, in terms of capital, clearly the private banks stand out because they carry excess capital over regulatory requirements as well. So, within the PSU pack, our preference has been for the larger PSU names where there is comfort on the liability franchise as well as growth remains intact. But overall, within banks, our preference for the private banks, specifically the larger private banks, remain.
Okay. By the way, the market's picked up a little bit. We were up 20, we're up 50 now on the Nifty, and this is a sharp move that we're seeing developing. Let's see if this holds. But this has come through in the last 8 minutes or so of trade. From 18,273, we're at about 18,320 now. On the index. Look at the bank Nifty as well. I mean, it's basically Reliance and banks. Reliance is contributing 11 points. HDFC Bank is contributing 6. Henderson is contributing 4. Bajaj Finance 4. And then there is an ITC as well, which is contributing 3.5, 4 points. So index points, that is. So the market's looking a little better. I mean, post 3 p.m. Let's see how that pans out. Look at Varun Beverages. I mean, stocks up 7.5%. 1620 numbers, of course, were super strong. I think it's one of those companies where earnings expectations have been upgraded for FY24 post fourth quarter performance. But I mean, just a absolute stunner of a wealth creator over now a very long period of time, very consistent. Shibani, do you? I mean, I don't know if you can talk about stocks, but do you own this one? Any thoughts at all?
Sorry, Prashant, I can't talk stock specific, so will not be able to comment on this particular name.
All right, fair enough. We'll leave it there then. Thanks very much, Shibani. Appreciate you joining in and running us through